Hi, this is Chad Sutton, certified financial planner and accredited investment fiduciary with Endurance Capital. Today I'm joined by Chris Cherry, who leads our investment department, and we're going to be going over how we're viewing the economy, the markets, and how we can help you.
So looking at slide one here, we can look at since COVID, we've seen lots of stimulus, supply shocks, and then rising inflation, which all leads to higher interest rates and market volatility. So that's why we're focusing on strategies that help protect our purchasing power and also keep our plans on track for whatever environment we're inside of.
When we look at this side specifically, we're really looking at real yield, right? The question is like when we're making a dollar, how much of that dollar do we get to keep? Either through inflation erosion or through tax erosion. So when we look at this in 2022, when the markets were going down, it was caused mostly by inflation. A lot of people poured into bonds, but again, those real yield on that bonds was negative. Again, we're seeing that rate go up, but now it's kind of stagnated at about 1.5%, 1.457, I'm sorry, 1.47% as of June 30th. So we're really kind of focused on bonds to get us started. This next slide shows us the history of inflation. So when we look at inflation over the course of a year, historically what's happened is inflation's a little bit higher in the first half of the year compared to the second half. What allows the Fed to review is what's happening with inflation month by month, and they could be in a position to cut because historically inflation's cooler in the second half. If interest rates go down, remember mathematically interest rates go down, bond prices go up. So that's why when we look at the right side of this chart, first half versus second half of the year and owning bonds and bond returns, we can actually see a little bit of a bump potentially in bond returns. This isn't really what we're wanting to do is pour our money into bonds right now. Again, we're looking for the action plan from the Fed to give us the confidence that we're ready to reallocate moderate and conservative portfolios.
Next slide is all about the yield curve. And if we look at the green line, it shows a peak inversion. And then if you compare that to the blue line, which is what we're at right now, we can see that we're in a much healthier yield curve. And that's why I think the question is being asked of why is there so many talks about being cut?
When I look at this slide, the green slide is showing this negative, right? Longer term rates are lower than shorter term rates. That's an inverted yield curve. And historically, that leads us into a recession. Still to this day, we have not gone to a recession since the peak inversion of 2023. And the economy looks to be in a much healthier place because of the yield curve where it's at today. So again, what Chris is laying out, that blue line, that middle line, we're seeing that go up. So you're getting paid to invest your money for longer periods of time, which again is a sign of a healthier economy. And again, the Fed's looking at it and saying, if the economy is so healthy, why are we needing to cut rates? Because again, typically, if you cut rates, you spur growth in the economy. And this Fed is really worried about spurring too much growth that creates more inflation like we had back in 2022.
So looking at the next slide with the Fed and interest rates, we can see that the market and what it wants compared to what the Fed wants are two different things. The green line shows what the market expectations are compared to the blue line that shows the Fed expectations.
We can actually see a big divergence here. The Fed, again, 3.6 versus the market at 3.03. The market's really wanting deeper cuts. Again, depending on who you listen to, a lot of economists were saying 3 to 4 rate cuts in 2025. Here we are in July. We have not seen that, right? And again, we're kind of running out of room. So it's going to be more and more interesting to see what they do in the next coming meetings.
So looking at this slide from the CME group, we can see that it's showing the probability of a rate cut in September. And now we know that there's a meeting at the end of July for possible rate cut, but it's not really pricing that in. So we can look at the September cut here showing 62%, and that's a quarter point cut from now until September.
And when we look at this, that's a relatively small cut. Again, there's some people that think we're going to have these massive rate cuts. Again, you only cut rates significantly if the economy was slowing or coming to a screeching halt. Again, there's a lot of things that are going on right now. What if tariffs? What if this? What if that? But again, like when we work with what we know, there's a lot of unknown. That's the only thing that's known. So right now, that's why the markets are only pricing in smaller rate cuts. Again, as the fundamentals change, our portfolios will change, our execution will change. But right now, it looks like a very small rate cut potentially ahead of us. When we get into rate cuts, we really want to step back and ask the question, how does this affect the consumer? When interest rates are lower, consumers are more confident to spend money. Now, the question there is when we're spending money, are they spending cash or are they going into debt? There's a lot of conversations right now that are happening that are saying more and more consumers are going further and further into debt. The reality is, yes, credit cards as a whole is an all-time high, but when we look at what's called the debt service ratio, this is asking the question, income to debt, are they able to service? And when we look at that chart on the left, we can see that the debt service ratio is actually healthier than what it was pre-pandemic, and it's much better than what it was during the Great Recession. So this is actually a very healthy sign. Now that's the glass half full. Let's talk about the glass half empty. Not all consumers are the same. And when we look at the chart on the right, what we're seeing is credit card delinquencies in the dark blue line is actually going way up. It's skyrocketing right now. So there's a group of consumers that are falling further and further behind, and we have to start asking the question, will delinquencies lead into bankruptcies? That could be problematic. The next thing that we would see on this chart is student loans. During COVID, payments changed. Now the payments are evolving, they're coming back online, and we're seeing a huge spike in delinquencies in student loans. And this is all before the big beautiful bill was passed and the student loan changes that are coming. So we would really want to keep our eye on this because it's going to affect a large group of consumers. These people are going to be starting their families, buying homes, spending money, doing a lot of things. And if they're cash strapped, maybe there's less money to spend into the economy, right? So again, we're watching this very, very closely.
So on this next slide, to Chad's point, we can see that, not all consumers are the same. So total net worth going up, but also the debt going up as well. I don't think it's as problematic because looking at the spike after COVID, we can see that the total net worth skyrocketed, but the actual debt went up. It just didn't skyrocket like the total net worth. So I think that makes us feel a little more comfortable just knowing that the wealthier consumers are still going to spend, so the economy stays stimulated.
When we look at the consumer, we understand incomes are going up, wealth is going up. When we look at income, we look at those that are employed. And the labor market is very, very difficult to get a handle on. We listen to unemployment rates, a lot of other things. I actually like to look at what's called the labor force participation rate. And that's on this slide on the left. And I actually like to break it down even more. So the light blue line are those that are 55 and older. The dark blue line are those that are between the ages 25 and 54. Now remember, the labor force participation rate is those people that are participating in the workforce. It doesn't matter if you're incarcerated, in school, able-bodied, everybody's included into this number. So I think it's a much healthier number to look at than the unemployment rate. And when we look at this, what we're finding is that 25 to 54-year-olds are working more now than what they have since 2007. So that's a very healthy sign. What we see in the light blue line is this number that's been come crashing down for 55 and older. When we work with clients in retirement plans, more retirees are feeling more and more confident to retire, even take early retirement, because their net worths have grown so much. And I think post-COVID, a lot of people are looking at time is worth more than the money. And again, their money's worth a lot, so now their time is more valuable. So we're seeing a lot of early retirees. So again, when I look at this line, I think it's a really healthy sign of how confident people that have wealth feel to make the next step into their life, into retirement. So as we make the shift from the economy to the stock market, when we look at the markets, there's an old saying, sell in May and go away. Now, historically, those that stay invested during all market cycles are the ones that win the most because nobody can predict the market. Nobody can time the lows, nobody can time the highs. So if you just stay invested, you'll have better outcomes. But when we look at this May specifically, again, the second best May, who would have thought that? Again, we had a lot of turmoil with tariffs, there were paused, and again, like there was a lot of unknown. But again, what we do know is that by just staying invested, better outcomes will be had. When we predict out to the rest of the year, this is where things get a little bit tougher because history shows us the average rate of return from June to December is 12.7%. But again, so far this year, it's been very healthy. And the awkwardness of the start of the year with tariffs, inflation, Fed cuts, we have not solved those. So our outlook is actually a little bit more moderate in stance because of these unknowns.
So looking at this slide, I think it really shows how different bull markets can be. Right now, we're in the 33rd month of this bull market, and you can see that we're up 73%. And then looking at the average duration of a bull market, it's about 64 months. And the average total return on 64 months is around 183%.
What starts the bull market is coming out of a bear market. And a lot of people believe that when we're in a bear market, that leads to recession, which isn't always the case. Again, when we look at where we're at right now, it feels like the economy's in a great spot. We're seeing healthy growth. We're seeing inflation cool, but it's staying very stable. We're not seeing deflation or hyperinflation. So again, it feels like we might have avoided the recession. And it does feel like there might be more legs to run on this current bull market. Again, we want to stay diversified and not become too bullish or bearish at times, depending on who's in office or what's happening in the economy. We want to find a risk-adjusted portfolio that matches your goals. However, there is one big element that we're keeping our eye on that has us pretty positive about the economy and the markets.
So looking at this next chart, it shows us that money markets are at an all-time high, which that means that this money's either going to be invested or get spent, which could be a lot of growth moving forward for the economy or the markets, or even both. So if you have questions about how the markets or the economy may be affecting your portfolio, our office offers complimentary portfolio reviews. So please reach out to 217-582-4343.